Here's to bold visionaries, faithful investors who make God the goal. While some may call them crazy, we see a joyful adventure. God has empowered us to use courageous capital, solving the world's greatest problems under His power for His glory. Welcome to the Faith-Driven Investor Podcast. Opinions expressed in this podcast, including the team and guests, are solely their opinions. Hosts and guests may maintain positions and securities discussed. This podcast is for informational purposes only. It should not be relied upon as specific investment advice for any individual or organization. Thanks for listening.
Friends, welcome back to another episode of the Faith-Driven Investor Podcast. And as you can see, for the first ever time in Faith-Driven Investor Marks on the Market's history, you can see us. So this is an exciting new normal for the FDI podcast. We're joining what our friends over on the FDE side of the aisle have been doing, and it's video podcasts going forward. John Coleman, it's great to see you. Brian McClard of Blue Trust, the Chief Investment Officer over there. What a joy to have you guys on. And just one quick logistical housekeeping item for our listeners. You're still going to expect the same release cadence from the FDI podcast every other week. Podcasts will be dropping. You got our monthly marks on the episodes monthly marks on the markets episodes that'll look like this in this kind of virtual format. So we're able to talk about relevant market data, meet virtually. But then in between, we've got the team on the FDI side of the house making beautiful video podcast release episodes. You saw one of those on Monday, July 28th, our last release with Henry and Ndidi from the Lions Den in DFW, where they were able to record a live in-person conversation. So fun new season ahead. I'm done rambling. John Coleman, great to see you. Tell me a highlight of the Coleman summer thus far.
Well, I'll start by saying now that we've moved to video, Richard, I feel like I should embrace a Lee Corso type persona here. Like maybe I should go up every week with, a company hat on, or Jim Cramer. Maybe I should start shouting a little bit more and slamming a button or something. So this is a new experience for us all. I'm excited for that. Summer is going great. I'm actually in Washington, D.C., the nation's capital right now, which is alive as always. The kids are spread out amongst various summer camps. And I think we're all ready for a little bit of routine as school starts back. So it's that time of year.
That's great, man. That's great. Yeah, as our friend Henry Kasner likes to say, he says he has a face for radio and a voice for print journalism. And so hopefully this is not to the detriment of our FDI podcast listeners that we're going video. Brian, how are things in Atlanta, Georgia, man?
Man, it has been hot here and fantastic. We're doing a kid swap. You talk about going back to school. We had one graduate from college. She's back home and working, and we're sending another one off. So we're staying even on the kid level, but doing a swap.
A net even. That's great. Where is the new one going off to college?
Georgia. Go Dogs.
Wow.
Congrats. Great school.
Reasonably local. That's amazing. Well, guys, we're doing Marks on the Markets. I love to kind of caveat when we're doing these when we're actually recording, so the takes we make don't feel out of date when the episode actually releases. It's Wednesday afternoon, July 30th as we record. This episode will released in kind of early to mid-August. August 11th, that Monday is the target date. But just this afternoon, the big news is that the Fed meeting concluded and rates held steady. And so let's start there, guys. There's been a lot of back and forth between the Trump administration and Powell and just kind of the interest rate conversation. Should cutting take place? Should they hold steady? It seems like the Fed is adopting and embracing a wait and see approach. Brian, let's start with you, man. Where do you kind of fall on this whole interest rate conversation? Maybe kind of frame it up a little bit for us.
Yeah, you bet. So obviously there's been, like you said, there's been a lively debate between our president and the chair about what rates should be. Apparently, rates should be about 1%. I think it's probably a little bit too low from my perspective. I don't think he's in danger of getting fired, though. I think there's too much in the incentive for the president to keep him around. He's only around for another year anyway. And who are you going to replace him with anyway? Because anyone else in there, they're gonna be ruled by reason and see that rates are actually pretty fairly valued where they are, at least in terms of the longer term. I think in terms of Fed interest rates, they could stand a cut. We're going to go with the fact that they're about 100 basis points overvalued. So we think rates could stand to be dropped to 100 basis points, but in absolute terms of history, it's about the 60th percentile. So slightly towards the tight side of things, but certainly not egregiously tight.
Brian, what do you think is driving that? Because I've heard different perspectives on why we'd keep them where they are. I know economic growth has actually been pretty strong. I know people are worried about which direction the tariffs will take us now that they're coming into clearer focus. Obviously, they could be inflationary because they'd necessarily increase prices on some goods, but they can also potentially slow economic growth as a result of that. Why do you think the Fed is so cautious right now about lowering rates, as you said? Because I think my gut would be to start dropping them 25 basis points, 50 basis points at a time right now, knowing that inflation seems to have cooled quite a lot. What do you think is holding them back?
That's a great point, but you've got labor really holding in there right now, and the Fed has flat out said they're going to watch what happens with the economy. You've got a bunch of questions out there with tariffs. All the agreements aren't even in. And so if there is that potential impact with inflation, I think the Fed would rather wait and see what happens rather than whipsawing the economy around. And so since they're given a little bit of leeway with the strong labor market and there's uncertainty with, with the tariffs and inflation, why not just, wait a little bit here?
Yeah. And to throw some data kind of behind that. So we've seen inflation falling. There has been the fear and the spike of what a tariff kind of environment can do. And that's still, a lot of that remains to be seen. I think August 1st will be one of the kind of the main effect dates when all of the tariff policies go into effect that are, blanket, not the one-off kind of conversations Trump and his administration have been having with each country. But we had inflation fall to 2.4%. It's kind of back up at 2.7%. So there was a little bit of that persistence and return, and you guys have spoken to it. We've had seen strong job markets, but I'm here in Austin, Texas, and I've got a number of friends who work for the large tech companies, and it feels like, at least from just what I'm seeing anecdotally, there's been a lot of quiet layoffs. And I don't know if that's preparation for AI boom or if it is something going on a more macro level. But those are the Fed's mandates: is price stability on the inflation side and then maximum employment. And so remains to be seen. You're actually even seeing some dissent in the Fed. You have a couple of governors for the first time maybe since 1993, and I need to go see what the vote actually was, who voted no in reference to the remainder of their 12 Fed board chairs. So it's just kind of fascinating that there is some disagreement amongst Jerome Powell's Fed. So any final comments, guys, on the interest rate conversation and where we are in that kind of 4.25 to 4.5 range?
John, I'd be curious to hear, how you are with where rates are. Do you think they're excessively tight, or would you like to see them drop?
Yeah, Richard knows I've talked about this before. You were spot on saying that we're much more in line with historical averages than people seem to recall. The challenge was that from 2008 to 2023 or so, we had one of the lowest rate environments in history, but it was so long that it became the new normal for people. Mm-hmm. If you go back to the 80s or to the 70s or even to the 60s, I think in the 60s rates were about where they are today. And in the 70s and 80s, they were substantially higher for most of those decades. And so we're actually not in that atypical a rate environment. It's just that it's been very atypical for this massive bull run in a low rate environment that we've had recently. I'm with you in that I actually think holding on to the higher rate for too long could risk the potential of a tightened economy. I think the housing market has slowed quite a lot. Even apart from the mortgage rates, housing prices have stayed sticky. There's more housing stock available now. Those are typically recessionary indicators, at least where they are today. I do worry a little bit about whether the labor markets start to get impacted. Richard, I think the tech labor markets in particular may be driven by something different, which is the AI boom, where a lot of programming jobs, middle management, there's just been this period where tech companies in particular are moving most aggressively on that front. I don't know where a lot of the blue collar labor or entry level labor is going to go. I think a confounding variable for me right now there is immigration. Obviously, we've slowed immigration quite dramatically. Border crossings are down. I think a lot fewer people are choosing to come here right now. Many are actually returning to their home countries. And that could actually translate into a better labor market for domestic Americans who would be filling into some of those jobs. So I don't really know where labor is going to go. I just feel like the Fed was slow to raise rates, Brian, on the front end with this transitory inflation. And it feels to me right now that they're a little bit slow to cut. And I wouldn't necessarily drop 100 basis points. It may be that we're 100 basis points above where we should be, But I think even dropping kind of 25 basis points at a time to see how it works, to see if inflation does tick up, to see if the tariffs have an inflationary impact. So to do that conservatively over a few quarters would probably be what I'd prefer to see, because I do get worried they're going to wait too long on the downswing like they did on the upswing, and that we could see a recession kick in if some of those housing indicators kick in, if the tariffs actually do cause a slowdown in some of the spending habits of Americans, et cetera. So I'd prefer to see them start signaling a lower rate and start dropping that way at least 25 basis points at a time.
Yeah, I completely agree with what you're spelling out there. I think dropping the rates so quickly would be really it would really be hard on the economy, I think, trying to process that so quickly. And actually, what I'd like to see is less intervention. So I like more of the predictability. I like them staying put. And I don't want them whipsawing the economy. I would rather them hang out here. They've always been late, as you've mentioned, and I think they will always be late. And so I want them to stay in that position of always being late, because when the time comes, they will respond. Rates are high enough now that there's ammunition back in the gun so that they can affect the economy, and they'll make the necessary cuts when needed. But right now, I don't think there's enough concern of a buildup of economic imbalances to suggest that they should act in advance of any kind of calamity.
John, you got into the housing talk a little bit. Brian, you're an unbelievable social media follower. So for anyone who doesn't know, go follow Brian McClard on Twitter, and you're going to get just charts and graphs and all the likes. It is a worthwhile follow if you're looking to get educated on Twitter and have some more wholesome content. But one of the things you spoke about recently was maybe some concerning signs in the weakness in consumer spending. John, you got into the housing conversation a little bit, but is there anything you guys are seeing as we get into kind of consumer spending on discretionary goods versus maybe the essential services, just the overall thoughts of like the U.S. household right now in this rate environment?
Yeah, so, there's obviously a strong consumer right now. I shouldn't say strong. Maybe consumer is still spending, but weakening. Certainly not recessionary right now. When you think about where they're spending, it sure seems like discretionary spending is still pretty strong, especially at the upper end. When you think about luxury travel and some of the premium experiences that people are investing in, if you've been to the Delta Lounge lately, I mean, forget about it. It's oversubscribed like crazy. Essential items like housing, food, gas, those types of things. From what I understand, those are declining. I think they're getting crowded out partially, so that might be driving some of that as well. But overall, the consumer is pretty resilient from a spending standpoint. Not really growing strongly, but not recessionary right now.
Yeah, I'm curious to see headed into the holidays with some of the true consumer discretionary spending on kind of things, material things, even food, et cetera. Because like Brian said, it seems so resilient right now, almost in defiance of the facts, because grocery prices have gone up pretty dramatically. They've flattened over the last 6 months or so, but they went up quite dramatically for a few years there. Actual consumer goods went up quite dramatically, and yet the consumer seems to be spending a lot. As we head into the holidays, I'm curious if some of the tariff action, particularly related to China, which I think the administration is saying that foreign producers are absorbing most of those costs right now. I think it's unlikely that a foreign producer is going to absorb all of those costs and simply erode its margin over time. So those will begin to translate into pricing. And a lot of the types of goods you'd see in like a Q4 spending cycle would be those that are imported. That's obviously a big spending season generally. And it's on a lot of things that would be subject to some of the import markets that we're talking about. And so I'm curious to see if some of those prices actually filter into the economy by that point, and if that negatively impacts consumer spending because of the rise in prices. But we don't have evidence of that yet at all. And certainly there's a delay or a lag in the impact of the tariffs, I think, on the prices of everyday goods, at least at this point, that may not even materialize by that time. There's at some point, though, those are going to filter into the economy. And I'm curious to see how that impacts spending patterns when it does.
Well, John, you bring up a really important point because companies right now have really high margins, and whether or not they're able to pass on these tariffs to consumers or whether they have to absorb them within their cost structure is going to be a critical tell of pricing power and consumer resilience in this next phase.
What do you guys think of this comment that Treasury Secretary Scott Bessent and Howard Lutnick kind of argue that the effect of a tariff, and calling they would almost say it's wrong or incorrect to call a tariff inflationary when the cost gets passed to the consumer, because they say, hey, there's a significant difference in a one-time kind of shock to the system and price increase versus this natural inflationary effect of just kind of a rising cost of goods. What do you think about that comment, John? I see you kind of coming out of your seat there.
No, Brian, start off.
No, I feel very strongly about this as well. In fact, I take it a step further that tariffs are actually a tax. And so in my mind, they redistribute wealth. And so therefore, from my mind, any kind of inflationary bump we get right now is just temporary. Because what do taxes do? Taxes redistribute wealth from one group to another group, and it creates really asymmetry in the preferred spending profile of consumers. And so to me, it is more harmful to growth than it is an inflation concern. And so to me, I'm not concerned at all about the long-term inflationary impacts of this.
Yeah, I agree totally. A tariff is basically a backdoor VAT, right? It's a value-added tax or a sales tax on imported goods. And I think it has other impacts. Certainly, it would help with re-onshoring of manufacturing because you get things more cost competitive. There are some other impacts that play out. But fundamentally, right now, the United States actually has one of the more progressive income tax systems in the developed world. And it's reached rates where there is some chance that if you increase those further, that you would have a transition of especially high income labor to other places. The UK is experiencing this right now where they've lost an unbelievable number of millionaires, for example. I can't remember the stat that I just read over the course of the last year or two because of some of the changes to their tax code that have been very unfavorable to those groups. And yet we do need more tax revenue to cover these incredible deficits that we're running. And you can't increase income taxes on the lower and middle classes. That's kind of an anathema approach to policy right now. But through a tariff, you're effectively backdooring a sales tax or a VAT tax that's much more broadly distributed. It's almost like a fair tax in the sense that everyone who purchases goods gets impacted by it. And I'm with Brian. It's less that it's long-term inflationary. It could, because of a temporary inflation, slow spending as things get one time more expensive, which I think is the impact I'd pay attention to. And then long-term, it's really a way of redistributing wealth, of taxing, and of potentially eating into the deficits that we're trying to figure out a way to deal with without cutting government spending, which is obviously one of the ways in which you could reduce those. So I'm with you, Brian. I think the primary impact is going to be as a tax that's just less noticeable than if we implemented a fair tax or a value-added tax.
All right, so let's get into it a little bit then in some of these specific tariff deals, if you will, and maybe kind of directionally how you guys are feeling about where we're going here. Because, John, you've alluded to it. A lot of this is to attack the glaring deficits, where we talked about the rates first, and if the large deficits and the big debt that we have and outstanding balance we have refinances at higher rates, then there's even more kind of catastrophic trouble in terms of just the amount of repayment we have on our interest as a country. And so one of the big deals is the US-EU tariff deal that was announced, capped at a 15% reciprocal tariff. There was the Japan deal that was recently announced, where instead of Japan paying a higher tariff, they agreed to almost a $500 billion plus deal with the United States as almost a signing bonus, is the words that Donald Trump used. And then there's this foreign direct investment of Nippon Steel, and that deal took place. So Japan kind of came to the table and said, hey, we want the lower tariff, but here are some kind of benefits on the front end back to the U.S. Directionally, just kind of how are you guys feeling about some of the deals that Trump and his team are brokering, where the U.S. is coming out? Do you think this is the appropriate approach to minimize some of the deficits and kind of drive up our revenue?
Yeah, so you know what? I guess I should go on record here that, frankly, I am not a big fan of tariffs for many of the reasons we've talked about. Yeah. And so that may be unpopular right now. That said, I can understand the path the administration is taking, because what it requires to lower the deficit is fiscal restraint. And the fact of the matter is, I also don't believe that our government will ever exhibit fiscal restraint. And so how do you ever do that absent a crisis that forces your hand, at which point so many more things are going wrong? So they're probably taking the best of the least good, or the options they have, to be able to force some fiscal constraint through this kind of mechanism. And so actually it'd be interesting to see how this plays out.
Yeah, what I like about it, Brian, is, and the thing I like from the beginning is, at the beginning of this whole process, foreign governments often did have higher barriers to trade for American goods than we had for their goods. And I do think that was an imbalance that we should have worked to correct, because if we were going to allow our market to be open, I would expect foreign markets to be as open, whether that's the EU or Japan or Canada or others. And at least on average across the board, foreign barriers to our goods were higher than our barriers to their goods. In a perfect world, my ideal, like Brian's, would be not tariffs, but actually relatively open trade policies that allow free access to goods across those borders in a reciprocal way. And only protection, and we may disagree on this, Brian, of certain critical industries, which I do think, and I'd be curious on your thoughts, but I have become convinced in healthcare, in pharmaceuticals and medical devices and certain food items, et cetera. COVID really convinced me we actually do need domestic or nearshore manufacturing of some of those things, so that in a crisis or in a difficult circumstance, we're not as reliant on distant geographies for things that would be critical to the function of our society. So I think that's a political kind of geostrategic wrinkle I'd put to it. But ideally, what I'd have loved to see is our tariffs go to zero with the EU and theirs go to zero for us, and us eliminate non-tariff trade barriers. That said, I do think the deals are probably more favorable to the United States, at least in the short term, than I thought they would be. I think you are seeing a lot of foreign governments remove real both tariff barriers as well as non-tariff barriers or other types of barriers to trade. And that, combined with a weakening dollar, which we haven't talked about because the dollar has weakened pretty substantially over the course of the last few months as well. I mean, mathematically, that almost has to lead to greater exports for the United States, some rejuvenation for those markets where U.S. companies do export in dollar-denominated goods, because now we do have more access to those markets, and the dollar is cheaper, so those goods are cheaper. And so I think we actually could see a boost, at least in the near or medium term, to American exports and production abroad as a result of these. And they haven't been as drawn out with the parties we've settled with, or as extreme as I might have expected them to be. They've settled in a somewhat manageable place, and they've often been on terms that are pretty favorable to the U.S., I think. Brian, are you seeing the same thing?
Yeah, absolutely. I can't disagree with anything you said. In fact, I agree with everything. And to the matter of having some protected industries that we do subsidize or protect in some way through tariffs, whatever that is, I'm in complete agreement. But that's a matter of negotiation. That's a matter of policy for the decision makers that have that at hand. That's not something that is absolute. That's going to be relative to the constituents' comfortability and the government's comfortability. As a broader perspective, I think it would behoove us to really have a posture of competition through free markets and a tit-for-tat balance of, if you don't have free markets, then we're going to be just as unfree as you. I think generally that results in kind of that Bugs Bunny escalation of, the gun to the cannon to the, to the ultimate annihilation of both. That's a little bit extreme, but my point is that doesn't end as well as just competing in free markets, even when others aren't as free.
We don't get many Bugs Bunny analogies on the pod, so I'm grateful you worked that in, Brian. All right, well, let's kind of shift gears to markets and maybe their digestion of all of this information. John, maybe we get back to the weakening dollar down the line here. But I guess big question, 6 months into 2025, more like 7 months into 2025, first half of the Trump presidency, have we landed the big soft landing? There was the great start to the year, if you will, or at least the stable start to the year, some kind of renewed urgency and joy around a new administration, the excitement of AI, maybe M&A markets are going to open back up. We have Liberation Day in early April, and we see a historic fall. And then all of a sudden we see a historic kind of climb back as some of the tariff news disseminated and settled. Overall, where that leaves us is the S&P 500 is up roughly 9% year to date. The Mag 7 is a little bit behind at kind of roughly 6.5% to 7% up year to date. You got stocks like Tesla and Apple having a challenging first half of the year, but then others up dramatically. But one of the things we're also seeing is within the NASDAQ, I mean, one of the highest level of first half listings all the way back since 2021. And so IPO markets are starting to wake up. How have the markets processed a lot of we've talked about? Have we landed that soft landing? Where are you guys feeling right now in terms of the market environment we're sitting in?
I'll start. Well, first of all, I would distinguish between the economy and the markets, especially now, because valuations can diverge. And in fact, if you look at U.S. equity valuations, we're in the 97th percentile going back the last 100 years. And so, in essence, all that U.S. exceptionalism, I would believe a lot of it is really priced in, and we're paying 40% more now for earnings than we were 10 years ago, as we're looking at 22 times forward earnings. And so I'm not saying that we're in a bubble by any means, but I certainly think U.S. returns going forward, even with the exceptional economy that we have right now, are likely to be more muted than what we've experienced the last 5 or 10 years. So I think investors should be prepared for that. And if you start comparing on a valuation basis to international markets, I think there's a lot of compelling reasons to really have a healthy international component.
Brian, I'd be curious to get your perspective. The conversation I'm finding myself in a lot today, notwithstanding the performance of the first half of this year, which you highlighted, Richard, is a lot of that valuation of American markets is driven by the Mag 7, or maybe a Mag 7 plus a couple. I think it's something like 35% or 40% of the index is now those 7 stocks.
I think it's up to 40
stocks. And their run for the last 5 or 6 years in particular has been extraordinary. So the S&P 493 or the Russell 2993 has actually had fairly modest performance during that time. And it's been these stocks growing. And the question I keep finding myself debating with people is, are they overvalued? Or are we in a new era where those 7 stocks or those 10 stocks are just capturing a market that is fundamentally the growth market of the future, with artificial intelligence, with robotics, and that type of forward earnings multiple is justified? Because if you just look at the historical averages, you'd say small and mid have to rebound, large cap has to go down a bit, the Mag 7 would want to revert to mean, and you'd expect the overall market for that S&P 493 to perform somewhat well, because they're trading at averages, I think, that are not quite as disconnected from historical averages, Brian, but being dragged up by these. Or is it just that Google, Microsoft, Amazon, Tesla are going to own the future, and actually that disconnect in valuation is because we're entering an era of consolidation driven by these technological changes where a few large companies will own the market? And I don't have a good answer for that. I think my intuition is that it's not the dot-com bubble. Those are fundamentally great businesses, but they're likely to come down a bit relative to the rest of the index. But I think there's a compelling argument that you never see a new era coming until it's there. And it could be possible that they're simply going to trade at a premium for a long time until this quantum computing, artificial intelligence, robotics wave is over. And so, Brian, I don't know if you have any reflections on that, or if you're seeing some of the same things.
I think those are very fair comments. And the fact of the matter is, I don't think anyone can see a way that these companies get displaced. But in fact, for us to have a healthy economy going forward, all of this investment, this upfront expenditures, has to find its way out to the economy. And these other companies, the rest of that 493 that you're talking about, have to experience the benefit of all of this technology and innovation. So that's number one. Number two, I would say that historically, then the risk is to them actually keeping that growth, because in a very innovative market like we've had, the leaders of the past have not been able to hold on to that leadership position going forward. So while, yes, I think that it's very difficult to find anything that is weak in their profit stance or in their or even in their moats right now, it's going to be a fight for them to hold on to. And you know what? We had a DeepSeek moment in January, which I know it's still under review, but that scared people an awful lot and suggested that you never know when it's coming, because as it is, AI came out of nowhere in 2022. Who knows what the next thing is? Things are happening a lot quicker. And then the third thing I think that is important to mention is that valuations. And so valuations have already, like I said, got to the 97th percentile. So valuations were about 30 to 40% of the last 5 to 10 years returns. And so right there, you either have to revalue from here up to get similar returns, or that's actually going to be a headwind going forward.
Yeah, and I want to pick up on one theme you mentioned, Richard, that we haven't touched on, which is the IPO markets and even the M&A markets, which intersects with private markets, where I spend a lot of time. I do think we're seeing an unclogging of private markets right now. For the last 3 years, funds have been very slow to return capital. We've seen fewer exits. The IPO markets have been stalled by a combination of an initial decline in valuation, so people were wanting to wait, fears of economic uncertainty, and then by a regulatory environment that was less friendly to acquisitions and to public listings. I think over the last 4 years, there was a much more restrictive regulatory environment around those things. I think now the signals from the new administration are friendlier to IPOs. They're friendlier to mergers and acquisitions, especially by larger companies. And there's just so much pent-up demand to liquidate some of these private holdings that people are starting to have to move on those. And I do think that could help with just the vibrancy of this S&P 493 or of the broader economy, both private markets and public markets, as you start to see companies going public, whether NASDAQ or NYSE, again, more frequently. You start to see more private equity activity buying from each other as they move into new funds and try and exit old funds. You start to see strategics acquiring things out of markets a little bit more, less afraid of some of the more restrictive regulatory environment that existed previously. So I do think that is probably a green shoot in my mind, because I think that might be a sustainable trend where we'll see increased activity in the private markets and with public listings and M&A in public companies over the next 18 months or so, which would help a lot because the private fund markets have been stalled in liquidations for the last few years. And it would be much healthier if there was a more normal turnover in those areas.
Yeah, I think that's a good word too, John. And also it points to one of these things in the IPO markets and the private markets is the AI conversation specifically hinges on such an important topic, and that's the energy conversation here in the US and just our desperate need for more electricity, which then all of a sudden opens up the door to other energy markets. Like there's always going to be liquid natural gas and just kind of our down the middle of the fairway energy production that is so crucial. But then it's now we're breaking into the world of nuclear and hydro and solar, and then where is that funded and where does that start? It's in the private markets. It's in these startups. It's in these kind of venture-backed type ecosystems that then all of a sudden, like you say, turn into M&A acquisitions and IPOs. And where do the large companies play into that? And so there's such a dependence and a necessity for the energy side of the equation that feeds down all the way into the private markets and where the startup activity must take place. And kind of talking about the AI conversation, this always goes in one of two directions. I don't know if you guys have experienced that. There is a optimism and almost a patriotism and the onshoring and all of the excitement that comes with it and where tech can take us. But then there's also this like great pessimism about job displacement. How are you guys feeling? How do you kind of reconcile that right now, especially in the seat we sit in as faith-driven investors and believers, as you process just what feels like us stepping on the precipice of a huge conversation and just the AI topic generally? Brian, what would you say?
Yeah, that's a great question. And I love the tie-in to faith, because the fact of the matter is that anytime you have a spirit of fear, it's really originating from a lack of control. And you have to ask yourself, whose kingdom am I trying to advance at that point in time? Because the fact of the matter is he's not given us a spirit of fear, but of power and of love and a sound mind. And if, in fact, he owns the cattle on 1,000 hills, and if he cares more about us than any sparrow that falls from the sky, then I think we have to ask ourselves, are we trying to protect our own kingdom and doing so out of fear? Or are we trying to advance his?
Man, that's awesome. John, what would you say to that? Brian, thank you, by the way. I love that.
Brian. That's a good word. And it's, it kind of aligns with what I've thought in the past. whenever people talk about Christians and science, it's like part of being a Christian is you believe there is a truth in the universe. And inevitably, if your faith is correct, you're going to end up at the same truth as anyone exploring this rationally would be.
Love it. Yeah.
And I don't think we have to be afraid of the future as Christians. I do think we want to be equipped to help our brothers and sisters, whether they're people of faith or not, navigate what I think will be a very disruptive time in history. And Richard, I won't repeat some of the things we said on this podcast before, but any period of advanced technological change, the industrial revolution, whatever, even if ultimately long-term it leads to something very good, is often very disruptive in the near term. And I do think we're sitting on the precipice of major labor market disruptions. I think there will be shifts between the types of jobs that people have. I think, like you said, this is an odd one because we're not actually automating away blue collar jobs right now or service industry jobs. It's actually going to hit the kind of middle class or upper middle class jobs first: computer programming, accountancies, law firms, et cetera. And it is, this combination of cheaper energy, which I do think is happening. I think nuclear is going to be relied on more. I think solar is picking up. I think we're exploring natural resources, oil and gas a little bit more. Robotics and artificial intelligence is going to create a step change for productivity, but also a change in labor markets, whether you're a truck driver or whether you're, a new associate at a CPA firm or a paralegal. There are going to be a lot of jobs at risk. And so I think as investors, it's incumbent upon us to try and think, okay, in the short to medium term, how are the companies I'm invested in going to be impacted by that? Mm-hmm. Many will experience cost savings, but some will have their business models fundamentally threatened by artificial intelligence, right? They'll be transformed. And as a faith-driven investor, you think, okay, I have a duty to my fellow human being. How do we create an environment where we can help people understand this change as it's happening, navigate it well, and potentially even from a policy perspective, help those who are displaced by these technologies and help them find their new role in the economy or how they can participate productively? Because long-term, Brian, we know where the story ends. In the short term, we want to have an obligation to others and help them navigate a very disruptive time.
I love that perspective. If I could add to that, we also find that in addition to that, oftentimes the fear does extend well beyond the impact. When you think about the impact of innovation, there are two components, really, if I can simplify it. There's a cost savings that you're talking about, where people really focus on in terms of the job displacement and everything is disintermediated. But then there's a reaching for new features. There's new boundaries that are crossed and new experiences that we have. And oftentimes you're reaching for both with new technology and innovation. But what you find is what comes first is, in most pronounced, is that reaching for new ground. And so over time, yes, the disintermediation happens. And you know what? We don't have yellow pages anymore. But that took a long time for that to eventually happen. And so there's more to think about than just the losing my job section. And that happens usually a lot slower than what most people fear will happen.
I had a fascinating conversation on that exact topic, Brian, because I think there is if you study history, you're actually a technological optimist in the sense that often we've gotten higher employment rates, better living standards for the workers because you're in safer work, your hours are reduced, and more prosperity, right? Every technological change has basically led to that for 5,000 years, at least over time. And so we should be optimistic about exactly the dynamic that you talked about. And aligned with that, I was talking to an economist in DC today who was doing one of the first studies on the impact of artificial intelligence on the job codes that they keep through, like the Department of Labor, et cetera. And they were expecting to see displacement where if you cross-reference what jobs are most likely to be displaced, call centers, writing jobs, et cetera, they were expecting to see reductions in workforce correlated with where LLMs were going to be the first to displace. And shockingly, what they found was actually increases in employment in those areas because people were trying to understand the causation. But it seemed like rather than just reducing workforce, that as people built out these AI capabilities, they were doing more. They were just doing it smarter. They were doing it differently. And companies were racing to figure out how to incorporate this to increase what they could offer to consumers, which was leading to much more resilient employment. than you would imagine. And so I'm entirely open-minded, Brian, about the dynamic you're discussing, which is we may be totally overestimating the displacement. On paper, it should be happening. On paper, paralegal work is going to be very easily done through an LLM. Just it's hard to predict ahead of time how this stuff is going to play out. And like you said, more often than not, it's actually led to increases in employment, at least on average or around industries, even if certain smaller segments like, the steel industry went away. Manufacturing in the US did go away over time. That shifted. But overall, it's led to even tighter employment markets and more prosperity. And so we might be overestimating that displacement.
Good thoughts.
That's interesting, John. It reminds me of I heard JD Vance give a talk not too long ago where he talked about the advent of the ATM machine. Everyone freaked out and said, hey, there goes the world of the bank teller. They're gone. The ATM will handle all of it. And there's actually now more bank tellers than there were pre-ATM machine, because it just unlocked the ability for the human to serve in so many more roles in the banking function and environment. And what used to just be an exchange of money is now turned into something far more, complex or robust, if you will.
That is a mystifying stat to me, because I don't know that I've spoken to a human at a bank in like a decade. But you're right. You're right on paper. I just want to understand who's going into banks these days.
All right. Before we go take this thing to a close here in a few minutes, two topics. Pick the one you like. Crypto, Bitcoin, the Genius Act, stable coins. Speaking of weakening U.S. dollar, John, so there is the new legislation that passed is the Genius Act, that essentially is going to provide some regulatory clarity for this concept of stable coins that would be dollar backed. The impact that could have is dramatic and massive. Speaking of bringing back demand to the U.S. dollar or U.S. treasuries, but then just the second thread of this that you're welcome to pull on is just as you look at the remainder of the year, maybe next 12 to 24 months. What are you specifically watching? So maybe I'll let each of you kind of pick one of those, and that will be our kind of zoom out conversation before we go home. Brian, dealer's choice. You're our guest here.
Well, I tell you, they're both so good. But the recent Genius Act and all that's been happening in crypto land is super exciting, just as we've been talking about. And that seems to be one of the primary threads that's underpinning a lot of the excitement around productivity enhancements. And so, how can we not address that? Because things like the Genius Act are super important in that they offer legitimacy to payment stable coins. You've received the government's blessing here, right? That was a lot of the frustration that folks were having with trying to get Bitcoin ETFs approved. And so to have that explicitly up front is huge. And then establishing regulatory framework for these to run on is fantastic, because that's just the way democracy and capital markets like to operate, are on predictable rails, and it gives consumer protection, it gives regulatory oversight, and the gateway and what we're going to see from this is super exciting in terms of, it's going to blur the lines between mainstream finance and digital assets. And I think we're going to see a lot of really cool benefits over the years. I don't know, how long it's going to take, kind of like we've talked about, for some of these to materialize. But think about everything that we do from, maybe it's loyalty programs where you have tokenized points on the blockchain that reduces, some of the overhead and increases security, but also helps consumers to maybe. What about buying a house? If you could handle your earnest money, and you could lower your closing costs, and you could do, verifying the home ownership on the blockchain. There's so many exciting things. And then, of course, in our world, if you could, have digital bonds and equities, you could really affect security settlement through smart contracts. You could streamline clearing and custody, and you could deal with counterparty risk. You could have fractional ownership and 24/7 trading. So there are just so many exciting things that I believe this sort of starts the conversation around.
Yeah, and I'll only add one thing, because I agree with everything that Brian said, is I do think the new legislation and the rise of stablecoins is probably good for the dollar as the global reserve currency. I know people have viewed it as a threat, but fundamentally a stablecoin is often backed or pegged against the US dollar. And as long as the dollar can stay a relatively stable currency. You know, we've had inflation, but it's not the type of inflation the developing world experiences, et cetera. I think it's just another avenue for foreign holders of currency to peg their currency against the dollar, especially if those are dollar-backed stable coins. And if you're in an incredibly unstable environment where your local currency is fluctuating wildly, the ability to avoid capital controls or to avoid having to hold in local currency and put in some sort of regulated and controlled and trustworthy stable coin that's pegged against a more stable currency is likely to drive demand for that currency. So I actually view, if this regulatory framework plays out, I think it's probably good for the dollar as a global reserve currency and probably raises the value of the dollar because there's increased demand for dollars as a result of that pegging. But I'm curious to see how that plays out because I think the way that it's trending now is probably good for the US dollar as global reserve currency.
Well, and that's an important point because there's been a lot of concern around our increasing deficits and what that does to interest rates. And so this adds another source of demand for treasuries, especially short-term treasuries, that really helps keep interest rates down.
That's a good point. I think that's one of the things where this administration deserves a lot of credit is that they have kind of, Brian, to the point you were making, they've gone in to say, let's get clear infrastructure and lanes in place where the game can be played and then step out of the way. And you can see them wanting to do that with AI. You can see them wanting to do that with energy. Let's cut the red tape. Let's get really clear lines and then now let the competitive markets take over and go play ball. And I think that's one where they're getting it right here. All right. Well, I wanted, neither of you took the other thread. So real quick, next 6 to 12 months, kind of couple of years in the market near term, what do you really have a close eye on? And then we'll take this thing home.
I do want to see what happens to the valuation of the Mag 7. Like, I'm super curious to see what the next 12 to 18 months bear for that and whether those are sustainable. And maybe you differentiate amongst them. Like NVIDIA probably has the most stable base of support in that market, I think, just in terms of they make a real product where there's almost insatiable demand right now. And it's difficult to see that demand decreasing. But I'm curious to see how the valuations of those stocks behave relative to the rest of the market and what that foretells for the rest of the market. And then I am curious to see whether this trend in public listings, M&A activity, and liquidity in private markets accelerates or whether it continues to be somewhat slow. Because if we keep following the trajectory of the last quarter or two, I think you could see a much more vibrant, broader market. But we really need to see that continue to accelerate to prior levels.
Yeah, Brian, what would you add?
I guess I would add, because those are really good. You know, I may look over your shoulder to watch those, John, but I would add tariffs. I mean, we started the year with tariffs. Let's see how this thing plays out. And then I'd be very interested in deregulation. There's a lot of a promise around deregulation. I tell you what, that could be a real game changer in terms of the economy. And then I'll just add a third thing on there is because they've made moves or overtures towards fiscal stimulus in Europe. And so I'd like to see if that plays out or not.
All right. I like it. Going international. Okay. Well, here we go. Brian, start with you. Man, what's God been teaching you in and through his word?
Oh, man. Well, I tell you what, he's been teaching me that being wholehearted isn't going to happen by accident. And I know that's shocking news for everyone. But, you know, even as a sold out believer, it's just really easy, at least for me, I'm speaking for myself, to forget that Jesus didn't come just to make good people a little better, but he came to bring dead things to life. You know, you think about, I love the image of Ezekiel and the dry bones just gaining flesh and muscle tendon. You know, that's what he does to us spiritually. And so I can't afford to be on autopilot, no matter what kind of pressures I have, no matter how busy life gets. And so I really have to be intentional about relationships. I have to be intentional about forgiveness and really just being involved.
Yeah, I would say a couple lessons, both from the New Testament and I've been going through the Psalms, as you know, a little bit more, and then mixing that with some of the New Testament. This importance of getting your own heart right in order to have a right relationship with God. You know, it's easy to ask for things. It's easy to wonder, you know, is God going to do something in my life? But the thing that we have control over ultimately is, do we get our own hearts right? Do we make sure that our behaviors are righteous? And none of us is perfect. So I don't mean that in too aggressive sense. We all have failures, but are we focusing on what we can do to get our hearts right and our minds right and seek God, and then trusting God to take care of the things around us in the way that he sees fit? Because so often I get caught up in asking for things and wondering why something's not happening, even as I'm not policing myself, as aggressively I should in my own heart. And in my scripture readings recently, it's just hit me time and again how the great figures in scripture were so focused on getting their heart right before they went and asked God for something, so that they were trying to, not that they were earning that, but that they were making sure that they were getting their minds and hearts right with relation to God. And they knew that they could trust God with the outcomes if that was correct. And that just gives so much agency to us, because we can't control whether it's in God's plan for something to happen. We can't control the world around us. But what we can control is guarding ourselves and trying to conform ourselves to the image of Christ and to the example that he sets. And there's a great freedom in that if we accept that responsibility.
Love it.
Good words. I mean, to kind of tie it back to Brian's thoughts, like, God, bring the dead parts of our hearts back to life.
For sure.
So we may repent and be in front of you, and then do as you will. Gentlemen, this has been fun. Thank you. Brian McClard of Blue Trust, what a joy to have you on. John Coleman of Sovereigns Capital. Friends, I'm Richard Cunningham. This has been the first ever video version of the Faith-Driven Investor Marks on the Markets podcast. We will catch you next time. Thanks for joining us.
Come for content, stay for community. Join a faith-driven investing group online or in person. Visit faithdriveninvestor.org. That's faithdriveninvestor.org.